Now, the World Bank is warning that despite an overall increase in economic growth, Sub-Saharan African nations are at risk of debt distress due to heavy borrowing and huge spending. The sober assessment comes as African countries continue to tap international debt markets and issue record levels of debt in foreign currencies, spurred on by insatiable investor demand for profit. In its economic outlook for the region, released in Accra, Ghana on Tuesday, the fund projected the rate of economic expansion would rise to 3.4% this year, up from 2.8% in 2017. The rate is boosted by global growth and higher commodity prices.
What we're concerned about is really the pace of increase rather than the level of debt on average. But what is worrisome is that in countries, particularly oil exporters, other natural commodity exporters, what we've seen is a pronounced increase in debt in the last couple of years. And there, of course, it reflects the big hit to their economies following the commodity price crash, the hit to revenue levels, the hit to their economies.
Meanwhile, around 40% of low-income countries in the region are now in debt distress or at high risk of it, and refinancing that debt could soon become more costly.
In much the rest of the region, the increase has been more modest, but still, it's on an increasing trend. And it reflects in most cases, basically countries being very aggressive in trying to address their development objectives, investment in infrastructure, in health, in education. So what we're calling for right now is, in those countries where debt has been gone up very aggressively, there's going to be need for significant fiscal consolidation. And in the other countries where the level of debt has been increasing more modestly, there it's about trying to find the right balance between investment and avoiding debt sustainability issues.
The IMF admitted that Africa's enormous needs will continue to demand heavy investments to build infrastructure and social development. But to do so while avoiding the risk of a debt trap, the continent, which currently has the lowest revenue to GDP ratio in the world, will need to become more self-reliant.
Look, fundamentally, over the medium term, what you want to do is make sure that the lion's share of your financing objective is addressed through revenue mobilization. And that indeed is, a lot of the work that we do with countries, how to be able to generate between 0.5 and 1 percentage point of GDP a year increase in revenues. So that is really ultimately how you want to be able to finance your development spending needs.
6 countries, Chad, Eritrea, Mozambique, Congo Republic, South Sudan and Zimbabwe, were judged to be in debt distress at the end of last year. And the IMF's ratings for Zambia and Ethiopia were changed from moderate to high risk of debt distress.